Welcome back. In our previous lecture, we have covered basic operations of commercial bank, and during this lecture, we are covering sources of funds of commercial banks. Commercial banks mostly collect their money through deposits. There are transaction deposits which are also known as current account. Depositors do not receive any interest against transaction deposits. These are also known as checking account. There are also savings deposit, and depositors receive interest against their savings deposit. These savings deposits are also known as passbook savings. Normally, depositors need to pay prior notice to withdraw money if it is a savings deposit. However, most banks allow depositors to withdraw a small amount of money without any prior notice, because nowadays against savings deposits we can use ATM cards and we can withdraw money from the ATM booths. Then there are time deposits, which are also known as fixed deposit. If money is deposited for a fixed term, this is known as time deposits. There are two broad categories of time deposits, and these are certificate of deposit and negotiable certificate of deposit, or simply negotiable CD. Certificate of deposit does not have any secondary market. On the other hand, negotiable certificate of deposit has secondary market, so depositors can trade among investors via dealers, but the minimum amount required for negotiable certificate of deposit is much higher than certificate of deposits, and in USA the minimum amount required for the negotiable certificate of deposit is $1 lakh. Then there are money market deposit accounts. Money market deposits accounts are more liquid than certificate of deposits, and there is no specific maturity for money market deposit accounts. Additionally, money market deposit accounts provide limited check writing facilities for the depositors, whereas time deposits do not provide any check writing facilities for depositors. Commercial banks can also raise funds from federal fund market, which is in our country known as call money market. Usually, commercial bank uses call money market or federal fund market for short-term loans. This federal fund is a short-term loan between banks, and it allows bank to meet reserve requirement or funding needs if a bank has liquidity problem. The interest rate which is charged in federal fund market is known as federal funds rate. In our country, federal funds rate is known as call money rate, because we call the federal fund market in our country as call money market. Banks are also allowed to borrow from Federal Reserve banks or from central banks. However, Federal Reserve banks or central banks are the last resort for commercial bank. If a commercial bank fails to raise fund from any other sources, in that case the commercial bank can apply for loan to the Federal Reserve banks or to the central bank. And borrowing from Federal Reserve bank is known as discount window, and interest rate of the central bank or Federal Reserve bank is known as discount rate. And in most cases, discount rate is higher than federal fund rate. The reason behind this is central banks or Federal Reserve banks want to ensure that commercial banks are going to the central bank or Federal Reserve Bank after trying other sources. So central bank usually intentionally keep the discount rate higher than other interest rate. This can be intended for meeting temporary short-term reserve requirement needs, and commercial banks are also required to take approval from the Fed or from the central bank. Nowadays, euro-dollar borrowings have become common among many banks. Banks outside the United States makes dollar-dominated loan, and these loans are known as euro-dollar loans. So, if a bank is situated in USA, and if the bank borrows from other country with dollar-dominated loan, that loan will be known as euro-dollar borrowing. And nowadays, euro-dollar market is very large. Banks can also issue bond if it is required, like other business. And normally banks issue bond to finance its long-term fixed assets like buildings or softwares. And bank has also access to its capital. Banks can raise capital by issuing stock or through retained earnings. The advantages of raising money through bank capital is there is no obligation to pay out funds in future. However, bank must have sufficient capital to absorb operating losses as well. That's all about this lecture.